Are you tired of juggling high-interest loans that are draining your business? What if I told you the SBA 7A loan program could help you refinance that debt and free up your cash flow? In this video, we're breaking down the rules of the SBA 7A debt refinancing in plain English. By the end, you'll know exactly how to clean up your balance sheet and make smarter financial moves. Let's jump in. First, what does it even mean to refinance with an SBA 7A loan? It's simple. It means you're using an SBA loan to pay off your old business debt. Why do it? 3 big reasons: better terms, consolidate multiple loans, and free up monthly cash flow. This part is super important. You can only refinance business debt, not personal stuff. So that means business term loans, equipment financing, lines of credit used for operating expenses, business credit cards, but not your personal credit cards, not your personal mortgage. The SBA has one rule they take very seriously when it comes to debt refinancing. You must be in a better financial position after the refinance. That could mean lower monthly payments, a longer term, lower interest rate, or a more flexible structure. If your new SBA loan doesn't help your business or makes things worse, it won't get approved. You can't just say it was used for the business. You need to prove it. That means your lender will want invoices, bank statements, the original loan agreement. If they can't verify the debt was used for your business, it won't qualify. But there's good news. You can refinance an existing SBA loan, but only once under the 7A program. And just like before, it has to improve your position. If it's an SBA 504 loan, talk to your lender. That's a different set of rules. Do you have high interest debt or a loan that has a balloon payment or coming up on maturity? You may be able to roll it into a more affordable SBA loan, but you'll need to show the debt was for business, it's already been used, and that refinancing benefits the business. Don't try to hide bad decisions or fake documents. SBA underwriting is strict, and it will get denied. Here's a quick no list. You can't refinance personal credit card debt, delinquent taxes, debt for passive investments, merchant cash advances, loans that paid off equity investors, or anything where SBA would be in a worse position. If you're not sure, ask your SBA lender to review it with you. Here's what lenders typically need to approve your refinance: original loan agreement including your note and the secured agreement, full payment history, a current payoff statement, and proof that the funds were used for business purposes. Let's talk strategy. Here's when SBA refinancing can be a game changer. You're drowning in short-term debt, you have multiple loans and want to consolidate, you need more monthly cash flow, or your current loan is maturing soon. Remember, SBA terms can go up to 10 years or 25 years for real estate. That can drastically reduce your monthly payments. If you're a small business owner looking for financial breathing room, the SBA 7A refinance option could be your way out. But remember, the rules are tight. You need a lender who knows how to structure it right. Need help reviewing your current debt? Reach out. Links in the description below. Thanks for hanging out with me today. If this video helped you better understand SBA refinancing, do me a favor. Like, subscribe, and share this with another business owner who could use a fresh start. I drop new videos weekly to help you grow your business the smart way with SBA. Until next time, class dismissed.